The Nasdaq is currently closed, but the last reported closing price for SoFi Technologies Inc. was $26.52 on Monday, November 17, 2025, reflecting a move of minus $0.57 or minus 2.01% from the previous session's close, with a relatively low volume of 248.69K shares trading at that specific snapshot time, which is significantly below the average. Now, the common expectation about SoFi is that it is the quintessential modern fintech success story, transitioning from a student loan refinancing platform to a full-fledged, nationally chartered digital bank that is poised for massive expansion and sustained profitability. The current reality, however, is that while the underlying business narrative is strong, with the recent Q3 results confirming raised guidance, accelerating member and product growth, and a definitive path to positive net income, the stock's daily action is constantly battling against the macroeconomic headwind of high interest rates, and more acutely, a very active and disciplined short-selling community. That significant daily drop we saw, even on the back of excellent forward-looking guidance, points directly to this tension. The market's expectation is long-term growth. The short-term reality is a struggle for consistent upward momentum driven by external factors and persistent skepticism baked into the trading floor. The general belief among retail investors is often centered around the ecosystem growth, the land and expand strategy of acquiring a member with one product, like a checking account, and cross-selling them into others such as personal loans or investment accounts. They see the rising member count, now exceeding 12 million, and the expanding number of products per member as the primary and unstoppable driver of future share price appreciation. But here is the deeper take that challenges this simple narrative. The stock's price sensitivity is still dominated by its lending division, specifically the personal loan book, and the market's perception of credit risk. The charter bank was a huge operational win, providing a lower cost of capital, yet the market is still pricing SoFi more like a high-growth, high-risk lender than a stable, diversified technology bank. This means every whisper about potential loan defaults, interest rate hikes, or regulatory pressure disproportionately affects the stock, creating the volatility we've been seeing. Look at the trading range of $26.45 to $26.60 in that closing period. This tight range, despite the overall down day, indicates a strong floor of buying interest battling the selling pressure, suggesting the dip was likely programmatic or linked to institutional rebalancing rather than fundamental panic. The volume being low adds credence to this interpretation, as true fundamental selling usually comes with explosive volume. Focusing on the recent movement, the stock has been an absolute beast year to date, up significantly from its 52-week low of $8.60, even hitting a recent high near $32.73. This massive run-up creates a natural setup for a pullback, which is exactly what we have observed over the past few weeks, settling into this $26 to $28 range. A substantial catalyst recently was the formal announcement of in-app crypto trading, a significant first for a nationally chartered bank. On social media platforms like X, the sentiment around this was overwhelmingly positive, with retail traders pointing to it as proof of the company's continuing digital leadership. Yet the price action has not sustained the initial pump, indicating that institutional funds view this more as an incremental product addition than a needle-moving shift in revenue. It's the lending business and the Galileo technology platform that are the true profit engines right now. Galileo, in particular, which processes payments for other fintechs, is a stable, high-margin, and high-growth fee income business that often gets overlooked in the consumer-facing narrative. It is this segment's accelerating and de-risked revenue growth that is the actual understated reason for the bullish long-term analyst ratings. The institutional activity is where things get interesting, and where the expectation versus reality dynamic is most clear. Institutional players, including giants like Vanguard and BlackRock, have large, long positions. In the most recent quarterly filings, we saw significant institutional accumulation, with some firms like J.P. Morgan Chase & Co. adding a massive number of shares, indicating a strong institutional belief in the long-term thesis. However, concurrently, we also see a high level of churn and rotation among other large funds, which explains the stock's pronounced daily swings. This suggests that while core funds are building a strategic position, short-term oriented institutions, often quantitative funds, are actively trading the volatility. This leads us directly to the short-selling awareness component, which is crucial for any investor tracking SoFi. SoFi is in fact under significant short-selling pressure. The latest short interest data, reported in mid-November, shows over 110 million shares are held short, representing around a 9.31% short interest percentage of the float. This is a noticeable amount and signals a cohort of sophisticated traders maintains a strong contrarian view. The short thesis is straightforward. The valuation is too high. A forward P/E ratio around 49x is steep, especially compared to the industry median of 24x, and that the company's impressive growth has been partly fueled by a period of historically high demand for personal loans, a trend that may not be sustainable as competition intensifies or the consumer balance sheet weakens. Furthermore, they bet on the idea that the cost of capital, while improved by the bank charter, will still be a persistent drag in a high-rate environment, constraining the lending margin. The days-to-cover ratio, a metric used to gauge the potential for a short squeeze, hovers around 1.27, which is low, and suggests that short sellers are not currently in a panic position. Short borrow rates are also quite low, sitting around 0.26% to 0.41%, which indicates that the supply of shares available to short is ample, making the cost of maintaining a short position negligible. Notable options activity, particularly the heavy open interest in put options, often indicates that professional trading desks are either hedging large long positions or actively taking a bearish view on the stock's near-term trajectory. For the retail investor, this low days to cover and low borrow rate should temper any hopes of an imminent rapid short squeeze event. To be an informed investor in a stock like SoFi, you must monitor these short-selling signals responsibly. Where do you find this information? Short interest data is officially released twice a month by NASDAQ, while failed-to-deliver data is released by the SEC. Keep an eye on the daily off-exchange short volume ratios, which for SoFi have been consistently high, sometimes exceeding 35% of daily volume. This is a critical insight as it points to a large portion of short selling occurring outside of lit exchanges, often by institutional players. An actionable step for investors is to use a free tool to track the options chain, specifically looking at the rising or falling open interest in put contracts around key psychological price points, such as $25. A significant spike in put open interest can signal a coordinated short attack or simply a massive institutional hedge. What's your take on the rising short interest? Smart money pushing a fair valuation or manipulation attempting to suppress the stock price? Comment below and let us know. It is clear that the short sellers are looking for a return to the long-term average price target, which many analysts have placed in the mid to high 20s. However, the counterpoint to the short thesis is the relentless execution by the management team led by CEO Anthony Noto, who has consistently over-delivered on guidance, particularly on the path to profitability. The intangible value of the three-pillar strategy, Lending, technology platform, and financial services cannot be easily modeled by legacy banking analysts, which creates a cognitive gap that short sellers are exploiting. When the company achieves GAAP net income for the first time, which is expected very soon, it will fundamentally change the narrative and force many institutional shorts to cover, regardless of the valuation multiple. That is the true catalyst the longs are betting on. Looking ahead, the future outlook for SoFi is fundamentally tied to two variables: the macro rate environment and the sustained growth of the Galileo platform. A rate hiking pause or cut from the Federal Reserve would be a massive tailwind for the lending business, immediately improving their net interest margin and significantly reducing the market's perception of credit risk. Conversely, if rates stay high, SoFi's stock performance will rely more heavily on the non-lending businesses, like Galileo and the brokerage and cash management services,